The office occupancy rate, 40.6%. On average this year, 50%. Going back to the COVID war, the damage it's done with the office building bust when people worked from home. And they didn't want to go back and commute an hour and a half each way, tired of spending all that money and giving up their lives. And people renting the office say, I don't need them here. Just come in a couple of days a week. I don't have to pay all this rent. There's going to be a banking bust. So whatever Trump does, when this thing goes down, he is going to do everything to artificially prop up the economy with fake money backed by nothing and printed on nothing and very low interest rates, which means gold prices are going to skyrocket. Now, going back to Wall Street on parade, this is an article they had. New York Fed report 27% of bank capital is, quote, extended and pretend in commercial real estate loans, which in part states the dire office building crisis as a result of the vacancy rates being covered up. We are the only ones that have forecast that. You go back to your Trends Journal, May 2020, when the war began, the COVID war, we warned this was going to happen. And then they go on today, they put another article out about what they reported. The guy was a financial research advisor for the New York Fed. And they go on to say that the losses that banks are exposed to in commercial real estate debt, the sudden large losses can be exacerbated by fire sale dynamics and bankruptcy court congestion. They keep going on and on and on, saying the exposure to illiquid and risky assets makes life insurers vulnerable to an array of adverse shocks, including that of an economic downturn, you ready, or a significant future deterioration of the commercial real estate. It's there for everybody to see. No one is talking about it. So I'm just saying this. You do what, the motto of the Trends Journal. By the way, these are the articles, back articles you could see here of the office building bust. And then this is how we end it in this economic update. Therefore, when building owners default on commercial real estate loans and banks don't have money to cover the losses, it will crash the equity markets and global economy. As a result of this crisis occurring during Donald Trump's presidency, he will do what he can to prop up equity markets and the economy. The results, as I said, will be lower interest rates, more fake money backed by nothing and printed on nothing, trillions of bailout money for the bankster bandits, and spiking gold and Bitcoin prices. That's our forecast. And again, we have the whole economic update, what the GDP did, what's going on with the fascism, giving money to these companies to do what they want, grants they call them, trends on the global economic front, all of the jobs that are being lost that they're not reporting on, all the businesses that are going out of business, the problems going on in France and Germany, throughout the Eurozone. India's economy slowed down. South Korea, you saw it happen. The guy called martial law and then they reversed it. So we had an article in here before this happened, and it's South Korea's central bank cuts interest rates because the economy going down so bad. When all else fails, they take you to war. This little clown bastard prick over there calls a state of emergency. And they're doing it all over. They're robbing more and more people of their freedom in every country that you can find. Like look at what they're doing over there in the UK, the FUCK, that guy Starmer and the little clowns. If you say this, you're going to jail. If you say that, you're going to jail. Yeah, no freedom of speech.
The global economic landscape is a precarious balancing act, teetering on the brink of systemic shifts that could redefine markets and wealth. As Gerald Celente has consistently warned, the signs of economic instability are not subtle. They're glaring red flags that too many are content to ignore. The ongoing trends from commercial real estate implosions to the relentless printing of fiat currency underscore an inevitable reckoning for both financial markets and the value of fiat currencies. At the center of this unfolding drama are gold and silver, assets that have stood the test of time as stores of value. Celente's insights into the commercial real estate collapse are particularly prescient. The fallout from the COVID-19 pandemic has fundamentally altered work habits, with remote work becoming a permanent fixture for many. This shift has rendered vast swaths of office space obsolete. A staggering 40.6% office occupancy rate, as reported recently, underscores the depth of the problem. These vacancies are not merely statistics. They represent a crisis brewing within the banking sector. Banks heavily exposed to commercial real estate loans face potential collapses as defaults mount and fire sale dynamics take hold. It's a domino effect waiting to happen, with the commercial real estate market's instability set to ripple across the global economy. The Federal Reserve's role in this unfolding crisis cannot be overstated. As Gerald Celente aptly points out, when faced with economic turmoil, the playbook remains the same. Lower interest rates, pump out more fake money, and hope the system holds together. This strategy of quantitative easing and money printing is not a solution. It's a band-aid on a bullet wound. The trillions of bailout dollars that have flowed to banks and corporations during crises have only exacerbated wealth inequality and eroded the purchasing power of fiat currencies. The implications for gold and silver are profound. Celente's forecast of spiking gold and Bitcoin prices in such an environment is not merely speculative. It's grounded in historical precedent. During times of economic uncertainty and currency devaluation, investors invariably turn to safe haven assets. Gold and silver have demonstrated their resilience as stores of value over millennia. Unlike fiat currencies, which can be printed ad infinitum, these precious metals are finite resources, their value intrinsic and enduring. One must also consider the geopolitical context. The economic slowdown isn't confined to the United States. Across the Eurozone, from France to Germany, economic indicators paint a grim picture. South Korea's recent interest rate cuts and India's slowing growth further illustrate the global nature of this crisis. The interconnectedness of modern economies means that instability in one region can quickly cascade, creating a worldwide downturn. Amidst these challenges, Celente's critique of the political establishment resonates. Whether it's the lack of meaningful audits of gold reserves or the government's reluctance to address systemic issues, the absence of transparency fuels public distrust. For example, the failure to audit U.S. gold reserves since the 1950s raises legitimate questions about the actual holdings. Without transparency, suspicions about the integrity of financial systems will only grow. The case for investing in gold and silver becomes even more compelling when one considers their historical performance. Since the dawn of the new millennium, gold has outperformed major stock indices, demonstrating its ability to preserve wealth. Despite this, there remains a striking lack of enthusiasm for gold among mainstream investors, who are instead distracted by speculative bubbles in equities and cryptocurrencies. Celente's warning is clear: ignoring the fundamentals in favor of hype is a dangerous game. Furthermore, the role of central banks in accumulating gold cannot be ignored. As Celente notes, foreign central banks have been net buyers of gold, a trend that speaks volumes about their long-term strategy. While retail investors in the West chase fleeting trends, central banks are quietly fortifying their reserves with tangible assets. This divergence in strategy highlights a critical blind spot among individual investors, many of whom fail to see the writing on the wall. Looking at the broader picture, the global economic system's fragility is evident. Debt levels are unsustainable, and the reliance on fiat currencies, backed by nothing more than promises, is a recipe for disaster. Gold and silver, by contrast, offer a tangible hedge against the inevitable devaluation of paper currencies. As Celente often emphasizes, these metals are not merely commodities. They are monetary anchors in a world awash with debt.
On to the markets. The S&P and NASDAQ hit a new high. That Trump bump keeps going up. NASDAQ, yep. The Dow, it was up a little bit. Oil, it went up a little bit, 73.69, because OPEC Plus is going to meet, and the guess is they're going to cut back on production. But it's not going to make a big difference, because the global economy, as we detail with one country after another, from France to Germany to China, all over, the economies are going way down. And so it's a supply and demand issue. So they may, they're definitely going to cut back on production, but other countries are going to put more out there. Unless, of course, or not unless, when the Israel and Ukraine wars keep escalating. That's the dangers of oil prices ahead. Gold was up a bit today. It's hanging in the same area, $2,642, up $601 since the start of the new year, when we call this a golden age for gold. And what else? Bitcoin, still hanging at that 96,000 mark. And there's the guess, is Trump going to go through with his pledges that he made to the crypto club when they gave him $200 million, that he's going to keep pushing this forward. We're bullish on Bitcoin. And again, money talks and bullshit walks. The money made Trump talk about Bitcoin, and the more dough they pour in, and if he's invested in it, watch the prices skyrocket. And then again, we have an economic update in this Trends Journal. And, we're saying it's basically, at this point, it's a guessing game of Trump sticking to what he's going to say on tariffs, on taxes. Again, he says one thing and does another. So the facts are there. Yes, some tariffs he stood by when he said he was going to do it. Others he didn't. He backed right off. The facts are there. We only put the facts down. So it's a guessing game. But the big trend that no one is talking about other than the Trends Journal is the office building bust and how that's going to affect the banking system. And I say this, nobody else is talking about it. We're the only ones. And now an article came out today on Wall Street on Parade, which is a great site that I suggest going to, which details what we have been saying that no one else is talking about. Go to Castle System, Kastle. Google it up. Yeah, we had the Thanksgiving holiday. The office occupancy rate, 40.6%. On average this year, 50%. Going back to the COVID war, the damage it's done with the office building bust when people worked from home and they didn't want to go back and commute an hour and a half each way, tired of spending all that money and giving up their lives. And people renting the office, I don't need them here. Just come in a couple of days a week. I don't have to pay all this rent. There's going to be a banking bust. So whatever Trump does, when this thing goes down, he is going to do everything to artificially prop up the economy with fake money backed by nothing and printed on nothing and very low interest rates, which means gold prices are going to skyrocket.
The office building bust is a symptom of a deeper economic malaise, one that many prefer to ignore. Wall Street on Parade recently highlighted that 27% of bank capital is tied up in extend and pretend commercial real estate loans. This revelation underscores the precarious state of the financial sector, particularly when considering the vacancy rates that have been obscured since the pandemic began. As Gerald Celente predicted in May 2020, the COVID-19 lockdowns were not just a temporary setback, but the beginning of a seismic shift in how economies function and how office spaces are utilized. Commercial real estate's vulnerability is a ticking time bomb. The combination of high vacancy rates, declining rental income, and over-leveraged properties creates a scenario ripe for defaults. Banks already exposed to these risky loans face a potential domino effect. When defaults become widespread, the impact will not be confined to the real estate sector. It will ripple through the equity markets and the broader economy. The interconnectedness of modern financial systems means that a crisis in one area can quickly escalate into a global economic meltdown. What exacerbates the problem is the lack of transparency and accountability. The Federal Reserve, rather than addressing these systemic risks, continues to inject liquidity into the markets, creating an artificial sense of stability. As Celente points out, this fake money backed by nothing and printed on nothing does little to solve the underlying issues. Instead, it inflates asset bubbles, delays the inevitable reckoning, and undermines the value of the US dollar. This brings us to gold and silver, the ultimate hedges against economic uncertainty. While the mainstream media focuses on equity markets hitting new highs, savvy investors are quietly accumulating precious metals. Gold has proven its resilience, maintaining its value over millennia and serving as a reliable store of wealth. In 2023, gold prices have surged, reaching $2,642 per ounce, a testament to its enduring appeal in uncertain times. Silver, often referred to as poor man's gold, has also seen increased demand, driven by its dual role as a monetary metal and an industrial commodity. The rise in gold and silver prices is not merely a reflection of market speculation, it is a response to the growing distrust in fiat currencies. Central banks around the world, particularly in emerging economies, are diversifying their reserves away from the US dollar and into gold. This trend, as Celente notes, is a clear indication that the global monetary system is shifting. The US dollar's role as the world's reserve currency is under threat, and gold is emerging as a viable alternative. Bitcoin, often touted as digital gold, has also captured investor interest. However, as Celente rightly points out, its volatility and reliance on speculative trading make it a risky proposition. Unlike gold, which has intrinsic value and a track record spanning thousands of years, Bitcoin remains an unproven asset class. While it may have a place in a diversified portfolio, it cannot replace the stability and security that gold offers. The office building bust is just one facet of a broader economic decline. Across the globe, economies are struggling. France and Germany, once the stalwarts of the Eurozone, are facing stagnation. India's rapid growth has slowed, and South Korea's central bank has been forced to cut interest rates to stave off a recession. These trends highlight the fragility of the global economy and the challenges that lie ahead. In the United States, the picture is equally grim. Job losses, business closures, and declining consumer confidence paint a stark picture. The Federal Reserve's policies, while providing short-term relief, have done little to address the structural issues plaguing the economy. Instead, they have created a dependence on low interest rates and quantitative easing, leaving the economy vulnerable to shocks. The political landscape further complicates matters. Donald Trump's presidency has been marked by efforts to prop up the economy through tax cuts, deregulation, and trade policies. While these measures have provided a temporary boost, they have also increased the national debt and widened the fiscal deficit. As Celente predicts, the next phase will likely involve even more aggressive monetary policies, including lower interest rates and increased government spending. These measures, while politically expedient, will only exacerbate the problems in the long run. For investors, the key takeaway is clear: prepare for turbulence. Gold and silver offer a safe haven in times of uncertainty, and their importance in a diversified portfolio cannot be overstated. As the global economy faces unprecedented challenges, these precious metals will continue to shine. In addition to investing in gold and silver, it is essential to stay informed. The Trends Journal provides invaluable insights into the economic, political, and social trends shaping our world. By understanding these trends, investors can make informed decisions and navigate the complexities of the modern financial landscape. The banking system's exposure to commercial real estate is a microcosm of the broader economic challenges we face. As Celente warns, the office building bust will have far-reaching implications, affecting not just the banking sector, but the entire economy. The time to act is now. Diversify your portfolio, stay informed, and be prepared for the changes ahead. The resilience of gold and silver lies in their intrinsic value and universal acceptance. Unlike fiat currencies, which can be devalued through inflation, precious metals retain their purchasing power over time. This makes them an ideal hedge against economic uncertainty and a reliable store of wealth. The growing demand for gold and silver is not limited to individual investors. Central banks, particularly in emerging economies, are also increasing their reserves. This trend reflects a lack of confidence in the US dollar and a desire to reduce dependence on a single currency. By diversifying their reserves, central banks are positioning themselves to weather potential economic storms. The rise of gold and silver prices also highlights the limitations of traditional investment vehicles. Equities, while offering the potential for high returns, are subject to market volatility and economic cycles. Bonds, traditionally considered a safe haven, are losing their appeal in an era of low interest rates and rising inflation. In this context, gold and silver offer a compelling alternative. The importance of gold and silver extends beyond their role as investment assets. They are also critical components in various industries, from electronics to renewable energy. This industrial demand further supports their value and underscores their importance in the global economy. As the world grapples with economic uncertainty, the case for gold and silver becomes even more compelling. These precious metals offer a unique combination of stability, liquidity, and growth potential. For investors seeking to protect their wealth and navigate the complexities of the modern financial landscape, gold and silver are indispensable assets. In conclusion, the office building bust and its implications for the banking sector are a wake-up call. The economic challenges we face are complex and multifaceted, requiring a proactive approach to wealth preservation. By investing in gold and silver, staying informed, and understanding the broader economic trends, investors can position themselves for success in an uncertain world. The time to act is now. Gold and silver are not just investments, they are the foundation of a resilient and secure financial future.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.